welcome everyone on the line to this webinar. It's something that we've been kind of coordinating and planning for a while, and we're excited to finally have it happen. My name is Albert Oswicki. I work for the Power Africa Coordinator's Office on the Financial Solutions team, which we have put together in the hopes of kind of figuring out some of the financial hurdles to power transactions on the continent, and really kind of digging in deep and working with a lot of our partners to best figure out how we can kind of marshal capital and resources to a lot of these transactions in order to bring them to financial close. I'm actually currently in Houston on a reverse trade mission with a delegation from South Africa. And last night we were having actually a quite spirited debate about a number of these issues. Talking about how there have been a number of funds raised and a lot of capital that has been raised, but there's been a little bit of a gap in terms of actually getting that capital deployed and into projects on the continent, and kind of really working through and talking through some of those issues and why it is the case. And the nature of the conversation just kind of really reminded me of the reason for being of Power Africa. We are about two things first and foremost. The first of those is being on a transaction basis. Really what we look to do is offer transaction debottlenecking and offer kind of advice and solutions for power transactions on the continent. And then the second thing that we do is really try to look at what issues are kind of inhibiting these transactions from moving forward, and working with our host of great partners, many of which are on the line today, to see what we can do about removing those inhibitions to transactions. So that's kind of what we do, and this issue is something that we have heard time and again from a number of our partners in terms of what is really inhibiting their deals from going forward. And so this is kind of the reason why we decided to put together this webinar. And I will kind of briefly touch on a survey that we got from the Emerging Markets Private Equity Association that was shared to us by the USAID Office of Private Capital and Microenterprise, which highlighted as of May that 75% of private equity general partners and limited partners found that this is either an important or very important topic for their funds. And 60% of them say that it either reduced their realized value from their investments in power projects or other projects in emerging markets. So time and again, we've heard this is an issue, and we really wanted to put together this webinar as a means of kind of beginning to address and wrangle with some of these issues. With that being said, I want to turn it over to Jane Ebinger, who's the Director of Policy at SEforALL.
Thank you very much, Albert. Just to give people a little bit of context, from an SEforALL perspective, Sustainable Energy for All has been consulting on a new strategic framework for results that would guide our actions and our engagement over the coming 5 years. And that was released this August and is available on our website. But one of the things that we heard strongly in those consultations was a call to support leaders in the business community, in the public sector, within civil society and other walks of life, in unlocking the finance that they need to be able to take the strategic investment plans they have and transform them into action, so that we can really focus on delivering universal access to affordable, reliable, sustainable and modern energy by 2030, the goal embraced in SDG 7. And, coming into this, Sustainable Energy for All released a report from its finance committee a year ago that took a look at what it would take to meet these goals financially. And, they estimated that there is around $1 to $1.2 trillion a year between now and 2030 that needs to flow to renewable energy, to energy efficiency, and to tackle the access challenge, but that currently only about a third of that finance is flowing, making the goal to translate investment plans into action, quite a formidable challenge. Risks in the markets, such as currency risk, which is the topic of the webinar today, was among one of the constraints that was identified in this finance report, but also cited by many operating in emerging and developing markets, as Albert has mentioned. So, we were very pleased to be able to come together to co-host this webinar with Power Africa and with TCX. We are very pleased to also be able to say that we envisage this would be part of a series that we could continue to co-host that would allow us to have some discussions around what, the challenges and solutions to unlock finance for sustainable energy. So, as you go into this, I think we're going to have a very interesting and lively discussion. But we'd also welcome your feedback, and you can provide this offline or as well on, whether this webinar was helpful for you and what other topics you'd be interested to explore into the future. With that, I'd really just like to thank Albert and the Power Africa team, Harold at TCX, Saloshni and Dirk, who are our speakers and will be introduced properly by Albert soon, and as well as our team in Vienna at Sustainable Energy for All, Anthony, Ben, and Eyal, that have made this webinar possible. And, I look forward very much to hearing the presentation and the discussion afterwards. Thank you, Albert.
Thank you, Jane. I quickly wanted to go over a few ground rules and introduce the speakers before we get into the meat of the webinar. So first of all, you'll be hearing from Saloshni, Dirk, and Harold for about 10 minutes each. And then after that, we are going to be having kind of an extended question and answer session. And I would really encourage everyone in the audience to participate in that session. We want it to be interactive, and we really want to hear from people on the ground or who are in the mix to get a sense of what their issues are and their perspectives are. To that end, in order to submit a question, if you guys are participating in the webinar, there's a chat function, and we ask that you guys would use the chat and send the question to all panelists. And really, this should be kind of live during the presentations throughout. If you have a question, if something someone says or things of that nature kind of raises a question, you should send a question and address it to all panelists. And to the extent that you want to have a specific speaker address your question, please flag that person's name in the question when you send it. And then lastly, we are hoping to have this recorded, and as well as having the slides and other materials be distributed to all of the participants in the webinar after the fact. So you all should be looking out for that. And that said, I would like to introduce the speakers. First, we have Saloshni Pillai, who is the Managing Director and Head of Corporate Distribution at South Africa office of Barclays Africa Group. Saloshni was appointed to that position in 2011. She has a kind of a breadth and depth of experience working on kind of hedging, derivatives, and swap instruments. And she has kind of been a partner with us from day one. We had a workshop at Africa Utility Week in May, and she was a speaker there and was very well received there. So we have Saloshni. And then next up, we have Dirk Munch, who is a co-founder of Persistent Energy Capital. Throughout his career, he's had stints working in capital markets as a financial analyst, as a trader of derivative products. And at Persistent, he's also produced a number of well-regarded white papers that I suggest you all read. They're kind of quite informative and in-depth and kind of really get into the details and explain them in a very kind of clear and concise manner. So Dirk will be speaking. And then last but not least, we have Harold Hirschhoffner of the Currency Exchange Fund. And Harold has been a key partner with us from day one on this. And TCX has really kind of been the genesis of this series of conversations that we've been having on kind of currency exchange and currency risk. If you all have not heard from Harold, I'll say, number one, where have you been? And number two, now that we have your email addresses, you should probably expect to be hearing from him after this this webinar. He's a very tireless and kind of passionate advocate on these issues. And so we're really pleased to have all of these kind of very qualified speakers partner with us and kind of share with us their experiences and their expertise on this issue. And with that being said, I will now go ahead and turn it over to Saloshini.
Thank you, Albert, and thank you everyone for joining us this afternoon. I must say, currency risk management has been my passion, but over the last few years, it's become very complicated to manage, and I think that's the value of these types of discussions, because it's not just up to financial institutions and specifically banks to provide the solutions. And I think as we move forward, it's going to take a collective of individuals, companies that operate in the countries that we talk about, central banks, governments, to basically align and move this forward. So I think when looking at risk management solutions across Africa, particularly with respect to currency risk, it's important to understand the financial markets and the regulatory themes that underpin these economies. I mean, if we just look at, and I'm sure many of you are aware, I mean, the impact of US rates normalization, sustained low commodity prices, and even the effects of Brexit have had a significant impact on emerging markets, as well as reducing FX liquidity in a number of African markets. We've also had quite a few central banks across the African continent tightening monetary policies and increasing FX restrictions, which have reduced the market's ability to use certain types of hedging instruments and to mitigate those financial risks. And then when you add the depth of these markets with respect to the types of volumes and tenors that can be facilitated, I think that's when it becomes a lot more difficult to manage. And it's a question that has come up a lot, especially when you look at energy projects and the implied risk that sits across currency, interest rate, and commodities. But for the purposes of this discussion, as we move forward, we've tried to actually focus on some broad themes and then some products that actually are relevant, that are doable, but it's how you think about them and how you embed them that's going to be quite critical. So within the slides, if you look at slide 3, and we look at the types of strategies, we did not want to go too technical into the details right now, but what we wanted to do is give you an overview of the types of instruments available and then the considerations around them. And then further thoughts when looking at energy projects specifically, how do we help mitigate this, and what are future discussions that need to be had in order to create the appropriate solutions to mitigate all of these risks. So when we look at the broad product types that are available, the one that is most simple and available in the market is a forward, which is basically a non-standardized contract between two parties to either buy or sell an underlying asset, in this case, a foreign currency, at an agreed price for settlement at a future date. The issue with this product, though, is because interest differentials are quite wide and interest rates specifically across Africa are quite high, they can be quite expensive when you try to use these instruments to manage FX risk. So what we've seen is that general risk management trends across the continent have been quite short-dated. So when you look at these power projects, that's where the difficult nuances come in. You have further two products that can be used, which is a swap, and this is a derivative contract that allows two parties to exchange cash flows based on a nominal principle. Each cash flow comprises of one leg of the swap. One would be fixed and one leg would be floating, and it would be benchmarked against an interest rate, a foreign currency exchange rate, or an index. And sometimes when we have foreign currency funding and local currency revenue streams, we need to consider what we call cross-currency swaps, which is a principal exchange of those two currencies. As an example, if you had a project in Zambia, and I'm using that for a specific reason given the restrictions in Zambia right now, where you had hard currency funding, yet some of the revenue streams were locally denominated or pegged, this management becomes a lot more critical in how you manage that, and the FX execution and support from the central bank in facilitating those trades. Finally, we also have options. Now, options is basically similar to what you would consider an insurance policy. It allows the buyer the right, but not the obligation, to buy or sell an underlying financial asset at an agreed price during a certain period of time or specified date at an upfront premium. And that's where it becomes tricky, because these upfront premiums can be quite high. And when we look at energy projects specifically, that premium can be used elsewhere where it's more needed. And also looking at financial modeling, it can add a lot of pressure on your debt service coverage ratios. So they can be structured as zero premium, but they're not always applicable in longer tenors. So I think the main crux that I'd like to bring to the discussion is it's not so much around the mechanics of the FX instruments that are available that's important. It's actually the markets in which you're operating, the liquidity, the volatility of those currencies, the economic conditions, and the regulations that actually drive what you can do and when you can do it. I mean, in certain countries currently, like Mozambique, Zambia, Malawi, Nigeria, Angola, the availability of hard currency is very, very limited. And to the extent that there are pockets of liquidity, it is picked up very quickly. So when you have long-dated risk, it's very difficult to benchmark that and mitigate that. And this is where the collective has to think about, how do we actually change this? Because it needs to come in at upfront when we are developing these projects, looking at the programs that are rolling out, understanding all the risk factors that are there, and then the hedging becomes a buy factor. I get asked quite often, why is FX risk so expensive, and that it's actually not worth doing? And the thing is it's the way you do it. So in South Africa, as an example, we've had a lot of success in the renewable program, and as you would have noted, it's round 3 closed quite successfully, round 3.5 has been successful. But it was quite a journey to understand the dynamics and the impact of the FX markets, because when round 2 actually closed, we had a fundamental shift in the financial markets in South Africa. The exchange rate had weakened over 30%, and the yield curve had increased 200 basis points. Not to say that this was the reason because of the renewable projects, but the renewable projects closed in a point in time where there was a lot of event risk happening globally that impacted EM. So what we've learned is that we need, and with the likes of National Treasury, the Department of Energy, is that we need to be more flexible and adaptable in how we roll out the program and the processes, to be cognizant of the risks that are there, and to look at ways of sharing the risk, and then looking at the risk mitigants through a risk management strategy. So the complexity in managing FX risk, again, is not about the mechanics, it's about the market dynamics. It is important to understand the underlying equity, financing, revenue cash flows, as well as the terms of the relevant agreement before determining the appropriate risk management or FX strategies. Understanding the risk factors when formulating tenders and RFPs from a government or public sector perspective is also critical, because it helps mitigate certain risks down the line. It is critical that even as we as financial institutions, government, through the central banks, and the companies that operate in these jurisdictions work together to continue developing these financial markets in order to grow cross-border flow as well as supporting liquidity conditions. So again, it's not about the instruments. We need to bring liquidity back to the market. We need to develop the local market so there's access to local funding. And we can do that by leveraging our investor base globally and looking at how we package instruments around creating that liquidity. So those are some of the considerations we've taken into account and what we are working on. Because as it stands, I mean, the fundamental headwinds that we are facing, not only in South Africa, but the rest of the continent, we're going to need quite a dynamic process in how we bring investor flows to mitigate the risk while working with government to share in some of the risk in how we benchmark foreign exchange exposures, how we build this risk when we look at negotiating purchase power agreements, and also looking at how we finance these projects. Because in South Africa, one of the aspects is looking at developing local content, so not all of the project's requirements are imported. So it's these sort of things that are actually going to move the dial when looking at different types of hedging strategies. So for me, it's going beyond now the products that are available, but actually working on developing the markets, leveraging all the sponsors and businesses that operate in these markets, and building products that can actually leverage the investor assets that are out there, and bringing the two closer together. So I think it's critical that, and it will be good to understand from the audience, what are their concerns. I've learned that there's no right answer at this point in time. It's actually, you have to work through the process, and just leveraging on my experience in South Africa through the renewable program, it's become seamless. It's a lot easier to facilitate. The risk is a lot easier to manage through the South African market. And even though the rand is relatively liquid compared to some of the other currencies on the continent, it's been exposed to a lot of volatility. So execution and the strategies around that then become relevant. So there's a timeline in how we build this. And the sooner we look at the risk factors across all of these key asset classes when tendering for these type of projects, will allow us to build a sustainable program that mitigates the foreign exchange risk that is quite topical to all of us. On slide, just to conclude, we've included on slide 4 some execution considerations, and it's talking very much to what I've mentioned, but also highlighting that there's a lot of work still to be done, because these factors on a standalone basis will not provide the solutions that are needed to make the project viable to create that sustainability. And I think from my side, I'd like to conclude on that, and then once we move to Q&A later, I'm happy to address any specific questions that come up.
Sure. Thank you for that, Saloshni. And again, I would just remind the audience, to the extent you have a question, please submit your questions to all panelists, and we will raise it in the Q&A session. I would now like to turn it over to Dirk Munch of Persistent Energy Partners.
Okay, thank you, Albert. Thank you, Saloshni. That was a really great start. Before I start, I would like to point out that there are typically two approaches to off-grid electrification, and they have slightly different consequences when it comes to FX risk management and FX risk hedging. I'm considering two different approaches. The idea to use projects for off-grid electrification, so larger grid-connected power plants, versus the use of operating companies that provide their customers with solar home systems or similar on a finance basis. And Persistent Energy Capital is very much focused on the latter part, on off-grid electrification by the means of operating companies that distribute decentralized energy systems to households and commercial customers. And that's also the background you need to see for this presentations and these few slides that I'm going to show you over the coming 10 minutes. It's a fact that the fastest growing companies in the off-grid energy sector today are pay-go companies or deskers. The key to this business model is that they offer their customers to pay for a solar home system or similar over time. In consequence, you have to understand that as these companies grow, they add with each new customer a receivable to their balance sheet. And accordingly, this receivable is by definition in local currencies. As the customers pay in local currencies, these companies build up large receivable balances on their balance sheet as they grow and as they scale. And to give you an idea, that's about $150 on average today in the market per customer. So a company that has 100,000 customers would have a receivable balance of something around $15 million on their balance sheet. And if we go to slide number 2, please. Actually, yeah, that's right. So from that perspective, if you think about the sector in 2015, we estimate that it added around, in total, the 5 or 6 largest companies added about $40 million in local currency receivables to their balance sheet, while at the same time being mainly funded with hard currency loans, US dollar equity investments, or the euro equivalent. The problem, however, is that the FX exposure that these companies are creating thereby can grow very quickly. And so the commonly accepted forecast for the off-grid energy sector, or for the PAYGO sector, is that by 2020, they will add somewhere between, let's say, 7 and 10 million units to the market. And that would mean, if the cost per unit remains about the same, that they're adding receivables close to $2 billion every year to their balance sheet. And obviously, it's easy to see from that perspective that this problem is very quickly getting quite large and can pose a potential issue for these companies. If you go to slide 4, you will see why that is the case. What I show on this slide is basically the devaluation of some of the major currencies in Sub-Saharan Africa. And I've in particular picked those currencies of the countries where we see most activity in the off-grid or PAYGO sector, if you will. And just consider, for example, Uganda, when 2015, at the end of 2015, when I prepared this chart, the local currency had lost almost 30% of their value versus the US dollar. If you consider a company that has a large local currency receivable on the balance sheet, they have just lost 30% of that value. And at the same time, their equity investors would still expect the same return as before. The solution to that is, at least in theory, quite simple. And sometimes it's a little overlooked, in the sense that if you lend in local currency, which is what these companies are effectively doing, they're providing small loans to their customers to purchase solar home systems. The best possible hedge you can have against that is if you also borrow in local currency. At that point in time, you're balancing your local currency asset with a local currency liability, and you have neutralized very effectively the currency risk. Another alternative, of course, is, and I mentioned that because we have actually practically executed it last year, would be for a PAYGO company to sell the existing receivables on their balance sheet to local currency investors or to an SPV, and then refinance that SPV in local currency. Now, when I say this, and if we go to the next slide, slide number 6, when we say this to companies in the sector, we very often hear the argument that while this is a good idea, the problem is that local rates are so high, and therefore the local borrowing, while a good idea, is just way too expensive. And this is something where we have seen a lot of misunderstanding still, and a lot of need for companies to take a closer look at the actual cost of a local currency loan. And I guess the key message I would like to leave here, because it would go way too far to try to explain this in greater detail, the key message I would like to leave is that just because there is a much higher rate on the loan doesn't necessarily mean it is a more expensive loan. On this slide, I have shown just very quickly how at the end of 2015, a 27% loan in Kenyan shilling, which sounds very high, 27% interest rate on a 3-year loan in Kenyan shilling at the end of 2015, was actually cheaper than a 9% equivalent loan denominated in US dollars. And this is described in way more detail in the paper that we've wrote. And I just would urge everyone to take a close look at this kind of comparison, because a higher rate doesn't necessarily mean a higher cost. If we go to the next slide, it comes, however, to the next problem, because even if companies and their CFOs and management teams accept the fact that higher rates do not necessarily mean higher costs, the next point they bring up is that the problem is that there is just no local debt available. And that is where we're getting into more complicated territory, where we have to borrow locally without local lenders. And there are three practical structures for this, I believe, and two of them Saloshny just mentioned. And that would basically to combine a hard currency loan, US dollar or euro, with a cross-currency swap, or to combine a hard currency loan with an FX forward. A third option, which was tested a little bit by the microfinance sector, which has gone through a very, very similar development, by the way, and has dealt with the same challenges, would be that a US dollar loan is deposited with a local bank, and the local bank uses that deposit in order to then lend in local currency. However, the third one is generally very expensive, and there are various other reasons why we have seen it executed rarely in practice. And with that, I would already like to conclude and maybe just repeat a few of the high-level comments that I've tried to make. The main issue that off-grid companies have, or pay-go companies have, is that they create very large local currency receivables on their balance sheet by definition of the business model. At the same time, local currencies, as we have seen, can lose value very, very quickly and are very volatile. And my message, and partly that also comes from my background as being a currency trader for some time, is don't risk it unless it's your core business, i.e. unless you really are in the business of managing currency risk. Therefore, we believe that pay-go companies, or DESCOs as we call them, should borrow in local currency to balance the local currency asset. In this context, we advise that the cost of local borrowing is very often much cheaper than the sticker price interest rate suggests. If there are no local loans available, then they should work with international lenders that can provide a hard currency loan in combination with a currency hedge. And there are several that can do this already. Very importantly as well, we believe there's still a strong need within the DESCO sector or the pay-go sector that companies build in-house expertise to measure and mitigate their currency risk. And at the same time, there's still a high demand that lenders to the off-grid sector should develop the capacity to lend in local currencies. And with that, I would like to conclude, and I hope this was useful, and I look forward to any questions you may have in the final Q&A session. Thank you.
Excellent. Thank you, Dirk. And again, I would reiterate to keep sending any questions you may have. I will now turn it over to Harold Hirschhofer.
Albert, thanks a lot. And Dirk, Saloshny, thank you for keeping to your time so tightly. First of all, I want to highlight that to this webinar today, almost 300 people got registered, and I think 110 or so are now participating or so. So I think this is a fantastic turnout, and it reflects, I'm sure, the convening power of Power Africa and SEforALL. But when I look 2 years ago, 3 years ago, when I tried to talk about FX risk, I had to pay people beers, coffees, and so on, that they would listen to me. Now we have 110 people worldwide participating. I'm very happy about that. Let me perhaps highlight one risk mitigation mechanism, which Saloshny did not mention in the context of Zambia. It's very relevant. If we could go to slide number 1, please. It was that the Zambian President Lungo called for a national prayer day in October 2015 of fasting in support of the Kwacha. Now that's and you know, one has to say, when you look at the Kwacha since then, it seems to work. So prayers have worked. But we at TCX, we didn't want to necessarily leave that at that. This is the main tool available in these exotic currencies. So if we go to the next slide, please. TCX was started in 2007, so 9 years ago, and we had a mandate to work together with commercial banks, with the private sector, to deepen and oftentimes create hedging markets on local currency financing markets. So Saloshni and I, we hopefully will work very often together that TCX can, with its risk-carrying capacity, help commercial banks deliver to their clients the hedging products they need. On this slide here, you see that TCX was started by development finance institutions, and we have very much a development mandate. So we have called it double bottom line. We want to be profitable, to be sustainable, but we mainly want to be additional and help expand the reach of markets. The good thing is our business model, which is based on global diversification and stable operating costs, is highly scalable. So the more we get used, the better we will function. And we see already now a very strong interest in the area of climate financing, but infrastructure financing more generally. And perhaps if there is time, I will get to that later. So if we go to the next slide, and this is something what Dirk touched upon. When you TCX was in its first years very much focused on transforming microfinance, and there was a general shift of moving from hard currency finance to local currency finance in microfinance, because people have realized it is dangerous to the consumer, it harms the interest of the poor people, and it is also bad macroeconomically to expose people who cannot carry the currency risk, to impose it on them. Oftentimes in microfinance, people got sucked into unwise consumption, unwise investment, because they thought the loan carries no interest, but they were not aware about the risks of the depreciation, and that had disastrous results, and it led to regulation, consumer protection. And I think we want to achieve now, together with our partners, that these ambitious access to energy goals are achieved in a financially sustainable way, not only in an environmentally responsible way, but also in a financially sustainable way, which protects the interests of the poor. But at the same time, when we issue our hedging instruments and work together, we want to empower local banks, we want to empower local players, we want to work with local pension funds, so that we can have also an impact on increasing the reach of the local markets. So, for example, one very important element is that local savings products can be created, and there are many. I think many good progress has been achieved, and wherever local savings are not enough to finance these investments, I think then one should go to the development finance institutions, to the foreign savings and foreign capital markets, and then comes the FX risk, and then TCX is one solution. If we go to the next slide, you see quickly how diversified it is, and you see all the TCX manages the currency risk by holding many positions. We have more than 50 currency positions all over the world. Sometimes in one currency we lose, in the other we gain, and by these offsets we can carry quite a lot of currency risk on our book. The next slide makes this a little bit more tangible. If you look historically at the distribution of various currencies, the currencies which had very large losses and very large gains, if you unify all those and make an average portfolio, you see that the average portfolio does not depreciate that much, and this depreciation effect is more than compensated by the interest differentials on average. If now this currency mitigation effect, when we go to the next slide, has a very, very important relevance, particularly today. Here you see over the last 5-6 years how some African currencies have developed. You saw we started this decade relatively stable, and suddenly, boom, emerging markets became more shaky. That's mainly related to the raw material price decline. You saw how the kwacha declined rapidly, and you know the Tanzanian shilling and the Ghanaian shilling. So this is very, very volatile. And so the TCX and currency hedging has become much more relevant in the past few years. The next slide shows, however, that if you take a very, very long horizon, and this is here over the past 200 years, you see that in most times in history, financial instability, and particularly here currency crashes, have been something which was quite often happening. It's not something special to the last few years or any geographic region. It happened regularly in history. And this here is taken from this very famous book with Rogoff wrote with Mrs. Reinhardt about this time it is different. People are always hoping, oh, there will be no crisis coming, boom, the next comes. This shows financial instability is a constant in history. Now, if we go to the next slide, I really want to now strengthen the message which Dirk sent before, that speculation is probably something one should not do. Now, what determines currency values? And if you go to the next slide, if you tap, please, I hope this will dynamically now show. Okay, you have internal drivers, which you can just go now because there will be now loading up quite. Okay, here you have the internal drivers of what drives currency values. You need to know a lot, and many factors can influence it. But say you are a local player, you have very good contacts locally. You think, okay, I have a good understanding of that. I'm a good macroeconomist. I'm reading the reports of the IMF regularly. I know even the IMF mission chief. Bam, if you go to the next, you have also external factors, which you have much less understanding of, and all this together. If you go again, tap again, please. If you see U.S. interest, what is China doing, what commodities, all these influences, and I think, you know, if you run an energy project or if you run a utility, this is something which you should not really take views on, and you should try to avoid betting on certain outcomes here, and you should not speculate. And if you don't believe it to me, if you go to the next slide, please. I tried to get someone more credible, to say it. So here you have the CEO of Credit Suisse, a very very experienced person, and he said, I did a lot of infrastructure development in my life. To fund them with foreign currency is madness. Okay, madness. So we started out with prayers and madness, and that was, by the way, also one of the title of a workshop we did together with KfW at the Africa Energy Forum in London in June. Can we go, please, to the next slide, which just quickly I run down what TCX is doing exactly. So we help development finance institutions and commercial banks issue loans in local currency. by taking swaps. So we work with DFI specialized funds. We work with the commercial banks. They can create a portfolio of swaps and then hedge the unwanted part of that with us. We also work on capital market solution, notes, papers, bonds. Whenever there are some type of FX risk issues, by say someone wants to buy a bond, but he doesn't necessarily want to take the currency risk, we can work with them. If no other option is possible, we would also work directly with solar home systems providers, the projects and the utilities. However, then we always have the issue of counterparty risk. Perhaps we can touch upon that in question and answers. I know I'm over my time already, but just two more slides quickly on the pricing. TCX, the costs of hedging are always reflecting the risks. If you are operating in a country where the macroeconomic risks are very high, you will see relatively high interest rates to compensate the investor for the risk. And this is exactly how we price. We price risk reflectively or market reflectively. That means the swap, when we enter it, with the interest rate we charge, we expect to make a small profit just to be financially sustainable, not to be super profitable, but to be financially sustainable. So we don't underprice the swap. That is important to allow eventually the private banks to take over from us and come in and replace us, and we will then move on to a longer tenor or to even more exotic currency. The last slide I want to show you is just from our homepage, from our website at TCX. Here you see, where the next slide, please. Here, if you go to tcxfund.com and you look for this for the products, you will come to this page which explains country by country what we can offer, how long we can hedge. So effectively, if you take the whole DAC development assistance list, in most developing countries we can offer hedging services. There are very few exceptions, 5 or 6, but so hedging is possible almost in any currency. So I would like to end with this and wait for your questions.
Excellent. Thank you, Harold. And before I go to the questions, I want to do a couple of housekeeping items. The first one would be that if you all have submitted questions, I would reiterate that you please submit them to all panelists so that we can get them and we can get your questions. We definitely want them to come from you as opposed to anything that I have. And then secondly, wanted to reiterate with you all that we will be sharing the slides after this, and those are forthcoming. We've gotten a number of questions on that, and just wanted to let you all know that those are forthcoming. With that being said, I will now go to a few of the questions that we have received from the audience. This one is generally, so for all of the speakers, what is the estimated annual volume of FX hedging in Sub-Saharan Africa, excluding South Africa, and how does this compare to the annual volume of FX hedging from South Africa?
Thanks, Albert. So maybe if I can start. So the tricky part about answering the question, I'll give you a sense of what we think it is, but there are no numbers that are officially reported. And generally the numbers that go through the regulators would be through the spot market. So it's difficult to get a sense of the more long-dated exposures that are hedged. But to give you a sense, the South African rand market is around, the average daily turnover is around $5 to $5.5 billion in the spot market. And I would say for Sub-Saharan Africa, excluding South Africa, it's probably in the current environment about 40%, and that's largely because Nigeria is significantly down. There's a closed market right now, and there's no interbank trading, and we've seen similar constraints in Angola. But that just gives you a sense of what is the type of spot volume, which is basically your interbank and corporate activity for FX transactions that settle within a 2-business-day period. And as in many of these countries, there's not a fixed income market, there's not a developed bond market, so it's difficult to predict what the forward liquidity would be like. I'm not sure if any of my colleagues have any input in that regard.
Okay. If not, I will go on and move to another question we received. He said, when dealing in West Africa, what financial institutions would you recommend us to work with?
Maybe I'll go first again, and I'll hand over to Harold. I would love to say us, but as you would have seen from my previous presentation, we're present in 14 countries. With Nigeria, we're actually still working on our full banking license. There are quite a few big local banks that are present. There are quite a few international banks as well. And I'm talking from, if you look at my competitors in South Africa that are present, and quite a few international banks as well. But it depends, I think it's more importantly what you're trying to achieve. Because it's not, as I mentioned earlier, on the instruments, but more what can be done in that market given the current dynamics. So in some cases, it's difficult to hedge long-dated exposures, and related to these types of projects, these types of programs, it's irrelevant of what the entity is, but more how to facilitate it between the investor base that's present and I would think the local central banks as well.
Well, if you want, I can, Harold, I can. I mean, in West Africa, there are, of course, quite a few of commercial bank, very well-recognized commercial banks with whom we are in regular contact, and I don't want to single out any one of them. But I think one can receive local currency financing, and they can contact us and work with TCX if to get to longer term structures. So that is possible. Many of the shareholders TCX has, which you saw in my presentation, I didn't point them out too explicitly, are also offering financing in West Africa. And also we are now in discussion with the West African Development Bank board to work with us. So there is quite a lot of opportunity there.
Okay. I have another question that just came through that I will raise for all of the panelists. It says, would it be possible to briefly walk through an example scenario of how an international impact investor that is providing a hard currency working capital loan, for example, 2 to 3 years, to a pay-go company can integrate an FX risk measure in the loan? For example, might a fund work with a local financial institution to arrange a local currency component of the loan? And if so, how? How should a venture arrange its fundraising activities to address this?
Harold, I think this is as much for you as it is for me, I guess. I think for an impact investor who wants to get involved in the off-grid space, the first real important step which seems to be taken here is that he or she recognizes that a local currency loan is what these companies mainly need. They also need some, hard currency working capital, but in order to finance the fast-growing receivable balance which they build by definition, they need local currency loans. This can be done in, as I tried to point out, in 2 ways. They could turn to TCX directly and work with TCX in order to offer the borrowing entity in country or the DESCO a local currency loan that basically consists out of their hard currency loan plus the swap or any other structure that TCX packs on top. The impact investor abroad receives a hard currency coupon. The DESCO locally has to pay a local currency interest rate, and TCX basically translates one into the other. The key here would be to see that it's best arranged by the lender with TCX, and that the DESCO itself only is the the borrower, and in the end doesn't even need to know that TCX were involved, because TCX would face the lender. The other option, which is also possible, but I think less practical, would be that the impact investor provides a loan to a local bank and asks the bank to use that loan as a guarantee against which to lend to the DESCO. The DESCO would pay local currency to the bank, and the bank would pay a small hard currency interest rate to the US investor. Then there are obviously variations whereby the impact investor, or if it's a grant-making institution or very concessionary investor, could assume some of the currency risk and just basically provide a backdrop. If there are any currency losses, he could accept smaller payments in hard currency in return. But that is effectively the same as assuming the currency risk at the investor level. And Harold would be sure you have a few things to add to that as well.
Well, you covered it very thoroughly already, but perhaps one remark. For me, this is, again, one of these the big dangers. If people want to do good, they give a loan in dollars at a very low interest or no interest rate, and then potentially the FX risk is then carried by a business which either doesn't fully understand it or should not carry it at all, or both. One possibility is, of course, if it depends on the size of the receiving institution, it depends on the size of the impact investor, etc. But if assuming that the local solar home system provider, they would have a banking relation with a local bank, they can, of course, try to ask the bank for a hedge. That's how I would do it first. That would be my first reaction. Go to your local bank, see if they can hedge you this dollar loan, if the impact investor doesn't want to do it in local currency, which is the first step. So if it's a dollar loan, go to your local bank. If the local bank cannot do it, tell them they should perhaps talk to TCX. We can then work with them to find a solution jointly. And if that doesn't go anywhere, then call us directly, and we will see if we can help you. That would be my answer.
Okay, thank you. Another question that we have, and this may be for Saloshni. It says, because local banks cannot provide risk mitigation instruments and Barclays does not seem to operate in the Francophone area, my question regards actual solutions for IPPs being financed on project finance basis with CapEx usually in US dollar or euros and PPA payments in local currency. Which products should we use? Hedge at contractor, SPV, or utility level? Thank you.
Okay, thank you. So I think it talks to some of the points we've made previously. Is it's also very difficult to hedge, irrespective of the bank, depending on the size. So I think the first point of call is you'd want to try and create a natural hedge as best as you can. So the ability to access local currency is going to be one critical factor. And then from a CapEx perspective, I think we're going to have to be very innovative going forward. There's also a number of these central banks that require hard currency. So looking at ways of ring fencing this with the central banks and allowing the central banks to provide the investment companies and the sponsors coming in with local currency to fund the local entities, and looking at how we benchmark the FX risk. So I think it's a combination of both what Dirk and Harold have said. You need access to liquidity. As TCX has mentioned, they trade in a number of currency pairs, but it will get tricky if it's a large volume, and trying to look for a natural hedge. So trying to access the local currency to offset some of that exposure, and doing through maybe guarantee structures as well. Instead of providing hard currency, looking for portals to provide guarantees to access the local currency as well.
Okay. Thank you. Another one that I've received, it says Ghana's feed-in tariff is pegged the rate against the US dollar. What kinds of currency risk do you envisage under such an arrangement?
Okay. So is that Ghana? Or just to judge
Yes.
you
Yes,
okay.
Ghana.
Okay. So what we've noticed in Ghana as well is the ability to execute hedges beyond 6 months can be quite tricky. But what we've realized is when you're engaging with the central bank, they're quite open to creating structured alternatives where you can provide hard currency and leverage the local market through the bond market, because they at least have a reasonably open bond market. And we can look at that as avenues to mitigate the currency risk. Again, though, it just depends on the size, the tenor of and what you're trying to achieve. In some cases, as you have in Nigeria, when the market is closed, it's very difficult to hedge and access that liquidity. And what we need to do in a point like that is actually work very closely as the fundamentals change, or we have access in managing that. We can look at it. And if there's currency pegs, not only in Ghana, if you look at the way, I saw one of the questions was around XOF being linked to euro. I mean, it's a matter of looking at hedging the exposure and taking on some basis risk that it's not going to be fully hedged. You're not going to get 100% hedge, but if you have a high correlation and you can hedge up to 75 to 80% of the risk, it's worth investigating. So it's looking at dollar hedges to mitigate certain exposures.
Albert, may I also say perhaps something on the currency peg in general, because we view it with some skepticism. Currency pegs sometimes make people feel comfortable when they should not be comfortable, in the sense that currency pegs work well with if the economy is highly integrated with the country it is pegging itself to and has a similar risk profile. If it is on a very different track, it's sometimes currency pegs are extremely risky because they work till a certain point and then suddenly everything crashes. I don't want to say anything about Ghana. In principle, I know too little about this country right now. But we see quite a lot of demand for hedging products, also where you have pegged currency to hedge this pegged risk. And I think it makes sense to consider hedging yourself against depegging as well.
Great. I'll move to another question. So the big challenge we see is that many private sector clients are loath to borrow in local currency. We have done 10 to 15 local currency deals in South Africa, but with the partnership of banks. Solution has played a big role in that. That said, if we have some home borrowers in Kenya being allowed by law to borrow in US dollars, how can we get anything to happen? I also worry that banks are withdrawing from Africa. We cannot get G7 banks to get back. What banks are going to step in?
Okay, I think I'll take a stab, and then my colleagues can step in as well. I think there's many different issues that were highlighted there. Maybe tackling the first one around international banks exiting the continent. I think taking into the broader frame around the global changes with respect to regulation, huge capital constraints, the pull of capital on international banks when investing in local banks, we're going to see that. But I think what's important is how there are strong African banks on the continent. And it's how you build that partnership in developing the market. And because there's always going to be entities globally that are going to look for African assets. So I think we mustn't lose sight of that. And the banking market on the continent needs to grow. It needs to work closely together. And we need the governments of those countries to do the same. So I'm actually quite optimistic that even though we're seeing a lot of maybe international banks downscaling, selling off, etc., there's still a lot of opportunity for the local players to build a stronger presence and to grow this market. The second thing is, I think, around to my first point, is that we're going to have to work closely with government and with public sector entities in how we move this forward, because regulations need to be cognizant of the impact they have when we're looking at infrastructure projects, when we're looking at bringing stability from a power perspective, from a water perspective, etc. So I think a lot more of the government and the ministries are open to these sort of discussions. It's, I think, going to be very critical in the education process and how we facilitate this. And I think as with PowerAid and Sustainable Energy for All, this is one of the outcomes is around bringing all the players together and having that constructive debate on how to move it forward. I think that's as much as I can add on that point. I'm not sure, Harold, if you've got anything to...
No, not really. I have not much to add to that question here.
Sure. I have another one that I'll ask, and I think, Harold, this is for you. Is there a minimum size deal for TCX hedging products? What percentage of the energy portfolio, if any, is for the off-grid sector?
Okay. So first of all, it depends really how you approach us and with whom you come. If you get financing, for example, from one of our shareholders, we have absolutely no minimum size. If you work with commercial banks and you get a hedge from them and they hedge themselves with us, I think that is depends really on the relationship we have with the commercial bank. So I would say that right now one can talk about most deals, so there is probably a very low minimum. Now, however, if energy project or someone wants to hedge directly with TCX, that means that upfront both parties have relatively high startup costs. We need to sign an ISTA, we need to understand the counterparty risks, a credit assessment. So we would only enter into a transaction with a non-shareholder, non-investor, if the transaction is either more than 5 million, or if there is a pipeline of transactions coming which is sizable. So also there we have some flexibility, but the important thing is it's always more cumbersome. However, there is one thing we have a TCX is working closely together with MFX Solutions, which is one of our shareholders, and MFX Solutions was specifically made to serve the hedging needs of smaller entities. So it's a Washington-based institution, and I think MFX Solution, if you go to the website, to the internet, you find it very easily, MFX. They can offer very small transaction sizes for renewable and then hedge themselves with TCX. On the question, the size of the energy portfolio, we do not really distinguish so much by sector. So we can take effectively as much renewable deals as we can do with our risk carrying capacity. We have no sectoral limits.
Okay, I'll step in with another question. What strategies would be recommended for hedging a hard currency loan with a longer tenor than is currently available in the market? How do these hedging instruments mitigate against rollover risk?
Maybe if I can give a view from a commercial bank perspective. So the tricky thing is it depends which market and what is the tenor. So to the extent that the bank is comfortable to carry that market risk associated with the tail end that's coming in because it's a longer dated exposure versus the market, it can be looked at, but it becomes a lot trickier because we'd have to go and offset that risk somewhere. and it can be quite expensive as well. So it's better to go in with shorter dated hedges. Yes, you do have the rollover risk, but it's how you build that in from a financing perspective, also from a project. In some cases, we've seen that there is restructuring opportunity at a certain point once these projects are generating revenue and are online, and it's the ability to get cheaper credit spreads in the funding allows them to restructure the whole transaction. And again, it just depends on the currency and what you're trying to achieve. But it is difficult to hedge very long-dated exposures. The only way to do that is to create the other side, and in the ability for us to issue longer-dated paper to our investor base to create that liquidity. But those are some of the things that we could consider with a little bit more detail.
So, Albert, I think this is exactly what TCX was created for, right? We want to step in when commercial banks, when Saloshny says, look, we can't do this, we can only do 3-4 years in that currency. This is when TCX should step in, and Saloshny hopefully will call us. We can do in many African currencies. When you have say you have a 10-year local government bond traded, we can go up to 15 years. So we extend the longest government bond point by 50%. In currencies where you have no government yield curve at all, we use macro models, and we are currently going up to 5 years fixed. And we are also working on a new product to go up to 10 years, perhaps even 15 years model based. So effectively, when we have this product available, that means there will be very, very few currencies left where there is this non-availability of long-term fixed rates.
Okay, I'll go to the next question. What role could public climate finance, i.e. concessional grant finance from donors or DFIs, play in helping mitigate currency risk in the transition to a DESCO market without any public support?
Perhaps allow me to take this, Albert, because I've been working on this for a while now on this question. Okay, we have been in discussion with DESCOs over the past 2-3 years, and pricing sensitivity is high. And Dirk, please comment on this also, because you're advising them. We have seen very often that just having a supply enough, offering a local currency product is not good enough to achieve the objectives. So we think what is very important is first that we have resources to explain and to explain what the local currency risks are. So we need to have TA. We have marketing campaigns explaining more, something what we are doing now. It's very important that donors support such activities, and I thank SEforALL that they are stepping into that role, helping us. But we may, in some currencies, also have a very specific problem that macroeconomic risks are so high that simply people are not willing to finance in local currency because the nominal interest rates seem absurdly high. In such circumstances, one could think of donors, of course, stepping in and helping DESCOs and their customers to take on such hedges and perhaps obtain hedges to cheaper prices. This is still in discussion, but that would certainly be one area, and perhaps it could contribute to a more rapid rollout of the DESCO model and access to energy.
Okay. Another question I have is, what about hedging projects with FX risks due to a currency that is not liquid and that banks do not accept?
Okay, maybe if I go first, because that's always a tricky one as a commercial bank, and it's something that we constantly faced with. When a currency is illiquid and you can't hedge it, it does make it very difficult, to be honest, which is why I think TCX was created, is to pick up that gap. And so I'm going to let Harold answer it. But there are other ways that we are looking at. If it's a matter of liquidity, is looking at how we can leverage our portfolio and the other risks that we see to mitigate that. So we create the other side of the market. But again, it just depends which country, which currency, and what we're trying to achieve. So Harold, I think that's actually more relevant for you.
Yeah, I just don't want to monopolize the answers too much. So, yeah, exactly. The TCX was created to provide liquidity in illiquid currency, full stop. We are having single currency capacities up to currently 120 million. We can take FX risks in the most exotic currencies. So I think right now, don't call us perhaps if you want to do something in South Sudan, Somalia, Syria, countries like which are just in conflict or post-conflict, because there is not we cannot help you there. But in all the others, Burundi or whatever, just give us a call. Sierra Leone, we just finished an FPAS. That is exactly our role, to give liquidity to these markets and to be there together with our DFI shareholders if commercial banks have not entered yet that market. So we are there to fill that role, to be that missing link, to make a solar energy deal happen, to make access to energy happen.
Great. Dirk, this one is for you. The question is, what if you're an operating company new to this space and you don't have in-house expertise in foreign exchange fluctuation, and this presentation and webinar have gone over your head? What resources are available and what do you recommend in terms of practical risk management?
Yeah, that is a good question. And so, yeah, I think a good starting point, and I'm sorry if it's on our own website, but a good starting point would be to read the report which we wrote late last year. It explains in great detail the concepts and ideas that are behind FX risk and FX risk mitigation management. I can also say that we provide advisory services to companies in the sector already, and that thankfully quite often there is TA available from various sources to support such activity. And to mention that here, it's not only Persistent Energy Capital that does this, but also there is a group of advisors called Open Capital Advisors that are also offering similar services, and they are working in the same way as we do with some of the TA providers and help early stage companies build this internal capacity. Because ultimately, I think capacity building when it comes to FX risk understanding and management is still something that's very much needed in the sector.
Sure, thank you. This next question is for everyone. How would the panel recommend the employment of partial risk guarantees in emerging markets to mobilize longer-term currency loans? Anyone want to tackle that one?
I think maybe I'll limit it. Let me take a stab at that. So, I mean, partial risk guarantees, and what I've seen of them, if you look at it from World Bank, etc., it does add a lot of value. It does help in how you structure transactions. But again, I mean, maybe if we could get a bit of context around that question. Is it specific to a country? Is it just Because in South Africa, there have been cases of this already. So I'm just trying to link it up to the risk management side. So if you can maybe get a bit more context, it'll be easier to answer.
Okay. I will ask the person who submitted that to provide a bit more context, and we'll pivot to another of the questions we have in the meantime. Another question is, how is FX risk managed in a country in recession with high FX risk and where the discos are financially insolvent and the local banks are not willing to lend to discos?
Perhaps should I take a first step, and then for the first part, and then if Dirk, you want to do the risk management part on the company level. On the macro side, if a country is in a recession or is doing well, it doesn't really make a difference on whether and how you should manage and hedge yourself and manage the FX risk. It's just the outlook is different, but that will be reflected in the price of a hedge. I think when I look at the experience we have had, for example, in Nigeria, there were times in Nigeria a few years ago when everything looked quite hunky-dory and things were well. I think that was the time generally when you should hedge. And we were in discussion with a number of companies at that time, and they said, well, it's too expensive to hedge, and I think now they would have loved to have hedged. So I think one should always consider hedging, and as I explained in my presentation, there are so many factors, external, internal factors, which influence the development of exchange rates that you should not speculate. I think it's detrimental to the business.
Okay, I can move to the next question. Would it be viable for operating companies that have established a unique relationship with their customers to mobilize deposits as a lower cost source of local currency? This could occur as part of a partnership with local banks or by acquiring banking licenses themselves.
I'll take a stab at that. I think that's a great question, and it's actually something that we've written on and about together with CGAP earlier this year. There's another report on our website, persistentenergy.com analysis, that goes into detail as to where the benefits are when it comes to collaboration or joint venture between distribution companies and financial institutions. Regulations and banking regulations are generally a big hurdle when it comes to implementing that. However, there is a great potential in using the quite sizable deposits that are already within microfinance institutions for exactly the same purpose, i.e. on lending to the same customers or other customers, such that they can afford and purchase an energy system. And so I think every initiative that goes towards local market deepening and using funds in local market, be this customer deposits or the investments in institutional investors such as pension funds or insurance companies, would go a long way towards addressing the currency risk. Ultimately, a cross-currency financed expansion of the energy sector, I think, is of high risk and not sustainable.
Okay. With that question, I think we're coming up on our time, so I would like to give each of our panelists a quick minute to kind of offer any final parting thoughts, and then we can wrap up. So we can start with Saloshi.
Thanks, Albert. So I think just given the questions and the themes that came out of them, I think what's going to be critical as we move forward is just understanding which are the countries of interest, what are the key risk factors, and again, because I don't think we've addressed a lot around the actual currency risk management strategies per se, but there's a lot that is involved in order to get there. So I think as a follow-up is we're happy to have that discussion and look at more bespoke solutions to try and unpack some of the questions we've seen. But I think this is definitely a very useful start, and it'll be also from a commercial bank perspective to get insights from the audience around what are they looking for going forward, and what are the discussions we should be having to help facilitate that.
Okay, and Dirk?
Well, I guess I would just repeat that I think there is a big need for capacity building when it comes to currency risk and risk management relating to FX risk, and that we could serve as independent advisors when operating companies, but also investors in the space would like to look into the issue and build that capacity. And I think that this is ultimately a very critical issue for the sector in order to develop sustainably.
Well, my ending line would be I'm very encouraged by this webinar and by the participation, also by the questions that people are becoming aware about the implications of FX risk, and that we need to find solutions to make sustainable energy also more sustainably financed. And I think my advice was generally challenge your commercial banker. Don't take a no for a no. Challenge him, push him further, that they come up with the right product for you. And TCX is certainly ready to work with the commercial banks, to work with the development finance institutions, to provide sustainable financing solutions for sustainable energy, and we can do this on a very large scale.
Great. Thank you, Harold. Thank you, Saloshni. Thank you, Dirk. And thank you to the team at SEforALL. I think this has been a great and kind of very robust discussion that we definitely look forward to continuing. I want to address a few kind of housekeeping items that we've been getting throughout the webinar. Number one, we will plan on making all of the slide decks available for all the participants on the webinar, as well as the papers and reports that Dirk referenced. And we're also going to try to get you all of the contact information for all the speakers who've spoken today. So you all should look out for that, should be forthcoming. And then in addition to that, this is the first webinar, but it's hopefully one in a series. So you all should continue to look out for additional webinars from SEforALL, TCX, Power Africa, and all of our partners, touching on issues such as this, as well as other issues in terms of financing power projects. Really grateful to everyone who's been able to work with us in putting this together, and we look forward to continuing to do the work as we march toward the goals of each of our respective organizations. So just wanted to say thank you all again, and we will be in touch.